So, what's recasting? I feel like this is a pretty commonly asked question that I've heard a few times. Recasting is when you make a lump sum principal payment and you want to readjust your payment based on what your new loan amount is. So, here's an example, right? Take out a 30-year fixed loan for $400,000. Your monthly payments are $2,500 a month. A year down the road, you get a settlement for $100,000, and you say, "Hey, I want to take this. I want to pay off my loan." Right? Normally, if you just wrote a check to your mortgage company for 100 grand, your payment is still going to be $2,500. Your balance will just be your balance will be 300, but that 2,500 will get the ratio of principal to interest will change. Right? So you have mostly interest, principal. When you make that payment, it's going to go down where you're going to be paying a higher percentage of principal and a lower percentage of interest. If you recast that loan, what you are actually doing is you are re-amortizing your monthly payment as if the loan was originally $300,000 to begin with. So obviously, $300,000 loan is going to have a lower payment than a $400,000 loan. 100 grand on a mortgage on a 30-year fixed loan is give or take about $650 a month different. So in this example, $2,500. If you had that 100 grand when you first bought the house, your payment would have been about 1950, right? So a recast, you're basically going to the lender and saying like, hey, I want you to recast this loan based on the new principal balance. So what they're doing, you have to put in an application. There's a couple of steps that are involved. Um, Typically, you're going to pay a small fee, $200 to $500. There are some requirements. You have to have been on time for the last 6 payments. Generally, the recast minimum amount is about $10,000, so you can't do it with $2,500. It needs to be a significant amount of money that you're paying your principal down by. And the big thing with recasting is it keeps the same terms, right? It keeps your loan terms the same, so you're not refinancing. You're keeping that same interest rate. So like where this could be advantageous is if you need monthly cash flow assistance, basically, right? And you have a bunch of money that you're applying towards the loan, but like let's say you locked in during COVID when rates were 2 to 3%, so you got a 3% 30-year fixed. It doesn't make sense to refinance to a 6.5, right? But you want your monthly payment to go down. So what you can do if you're going to apply a big chunk of change to that loan is recast it. You'll keep your 3% interest rate, and the payment will get adjusted down based on the new principal balance. Where this does not make sense, obviously, is if you bought. There were a couple of months in 2023 where rates were, like approaching 8%. So if you've got a 7.75 interest rate and rates are now 5.5, right, and you want to take $100,000 and apply it towards your loan, in that situation, a refinance would make a lot more sense because you're killing two birds with one stone. You're not just re-amortizing and keeping the same term. You're also reducing your debt service cost on a refinance when current market is lower than what you have on your mortgage. So there's a little bit of calculation that needs to be done on comparing like refinance versus recast because obviously there are costs associated with refinance that are not associated with recasting your loan. So there's a formula that we do to kind of determine like, hey, here's your net benefit. This is what the savings in monthly payment. If you're looking at refinancing, here's the monthly payment savings, but also here is the debt service savings, and you're basically paying this much less in interest than if you recasted. However, here are the costs. So if you're saving $500 a month in interest and it costs you $5,000 to do it, then there's a break even point of 10 months, right? Just as a very round number example, it's rarely exactly, it's usually like 9.5 or 15.7 months, but just so you have a good idea. But that's it basically. I mean, it's a pretty straightforward tool. If you're applying lump sum principal balance, it lets you reduce your monthly payment if you need that cash flow. And just like anything, depends on your personal circumstances. Could be the right move for you, could not be.